Hello and welcome to the next episode of War in the Markets. Well, first of all, I must thank all the people for the feedback. Some of them have been saying that the volume is low, get a microphone and all of that. So I've taken using a microphone today. Do give me a feedback on how the volume comes through, right? So today's market was a very interesting market. Nifty was down about 0.4%. Mid and small cap index were up. Micro cap was marginally down. So the key geopolitical development today was the fact that oil prices spiked up to $111 because the Iranian proposal was rejected by America because they made it contingent upon the nuclear thing from America's side and lifting of a blockade from Iran. So the war situation doesn't like is getting it solved. But the spike in oil should have led to a much larger correction in the market. It did not. And the reason for that, I suspect, is because of the Fed meeting, that the two-day meeting discussions start today, and by tomorrow we expect a Fed decision. So FIIs were a little bit, dropped their amount of selling. They sold only 2,000 crores today compared to the 8,000 and the 5,000 crores over the last 2-3 days. Even the DIs were very soft in their actions today, only 1,700 crores of buying, right? And if you look at the clues for the market, the advance decline ratio actually again turned adverse. It was about 1,200 advances and 1,700 declines. So all of this put together means that even the mid and small cap rally that you saw was a very polarized. It was not a broad market rally. A few sectors and stocks did very well to push up the mid and small cap index. So that clue to that will come from when you look at the sectoral positioning and you realize that today was the news about the RBI on the credit provisioning norms, the putting the new norms in, which makes it a higher capital requirement for largely for public sector banks, and hence they were the underperforming sector today. The rise in oil price meant that energy and metals, which are all linked to that, went up today. The impact of the oil, however, was seen very clearly in the currency. The currency hit an all-time low of 94.5, and if you take even the forward premia spiked. So 1 year forward has now breached the $98 mark, right? So all of this, then where does it really reflect, right? Because today is the index expiry day. So as a result of which, I think the FI actions were also more focused on either rolling over or adding. And if you look at the three components of the F&O, that's the index futures, then the index stock futures, and the index options, you will see that FIIs actually added about 20,000 more shorts today on a rollover day. So in addition to rolling over their shorts, so the long short ratio today was actually 0.12. So it's huge, almost 8 times the amount of shorts compared to longs as they go into the May sessions, right? So clearly FIS have a very bearish outlook from the index futures. Stock futures, they have been long for quite some time. They continue to be long today because they are taking very stock specific actions on which stocks can do well. If you look at the options side, the FIS obviously were short calls, right? Selling calls, but they also bought heavy puts to protect from the downside. So very interesting. That is, they are preparing for a bearish period for the markets. The retail and the domestic, if you see the players, the DIs, the retail were all in the long short side. They're all long, so they are contra to the FII. And in the option side also, if you see, retail is actually the opposite of the options stance of the FIIs. So they are actually providing the liquidity for the FIIs who want to buy protection. They are selling protection to the FIIs. So clearly this means that the market is very, very polarized. And what are the triggers now? If you look for tomorrow's market and for the future, well, the Fed rate decision is important from an FII, from an emerging market situation. The Hormuz Strait issue is also very important. And third is the earnings season. So what if the market has to go up, then you have to have a solution either to the Fed getting very dovish, unlikely scenario, but Fed getting dovish, or in the Hormuz Strait, in which case all these shorts of FIs get covered and there will be a bounce back in the market. On the opposite side, if the earning season develops, then you can expect DIs who are still not putting their full energy behind buying to step up the buying. Even now, you're seeing that any single sector, single stock reaction on the earnings is very, very strong from the DIS side. So that will continue. So all in all, then entering into May after tomorrow, we are going to enter into a very volatile market with a slightly bearish tint. It's the ideal market to keep accumulating, right? And like I said, hard to pick sectors bang in the middle of war and bang in the middle of the earnings season. So do not pick sectors and stick to the strategy of steady gradual accumulation, right? Thank you and look forward to the next update.